Hey, let's go ahead and get things moving here with a webinar this afternoon. I'd like to welcome everyone to the 6th installment of Trend Watch, which is a series of webinars that we've been doing to focus on topical issues and opportunities facing asset allocators and fund managers. My name is Tim CraigHead. I'm the Senior European Equity Strategist from Bloomberg Intelligence here in London. I'm also one of our directors of research. And it's an absolute pleasure to be here with you, as well as a few other panelists. And we'll look forward to a lively and interesting discussion today. Let me go through a little bit of housekeeping before we start, just to set the stage. Number one, as I mentioned, this is the 6th of a series of webinars, and I would have you mark your calendar. The next one is scheduled for late April, the 27th, and this will be focused on investing strategies in fixed income amid inflation volatility, inflation uncertainty. Certainly quite topical these days. And secondly, from a background perspective, I'd like to give you just a little bit of information about Evenco as well as Bloomberg Intelligence, to the degree that we're partnering in this series, as well as some other events. And just want to make sure everybody's aware of both groups. You know, Evenco is an organization that is in the middle of bringing together asset allocators and funds that can marry together from the standpoint of investment opportunities. They run in-person fund forums across Europe. There's an organization or a group within it called Evenco Analytics that has got some really intriguing data from the standpoint of asset allocator surveys with views on investment positioning across all sorts of different categories. And with these in-person events, I was actually just in Stockholm last week. Oslo is coming up in mid-May. There's London, Madrid, Geneva, Zurich, Frankfurt, etc., and several others coming over the next number of quarters. Certainly really intriguing events to be aware of and potentially participate in. Bloomberg Intelligence is a full-blown investment research team. We've got 400 people plus. We cover all markets, all industries, 2,000 companies. It's all accessible on the Bloomberg terminal, packed with data, research, and up-to-date outlooks across these industries, markets, and 2,000 companies. If you got a Bloomberg, you have us, and we'd certainly look forward to engage with you. Now, with me today, I've got three, I think, very good experts in various ways with the topic that we're going to explore today. The first, Kalinka Dyankova, is a senior fund analyst at Kleinwort Hambros. Secondly, Sarita Gosrani is the director of ESG and Responsible Investment for bfinance. And thirdly, Rob Barnett, a colleague of mine here with Bloomberg Intelligence, is our senior analyst covering clean energy here in Europe, but he focuses on global businesses as well. And with that sort of introduction in mind, what I'd like to do to start things, as far as the content goes, is to ask our three panelists to give a little bit of background on each of you, what you do, why you're interested in the topic of investing in carbon reduction. Kalinka, would you like to lead things off?
Sure. Good afternoon, everyone, and thank you very much for the interest. It's a great topic, and definitely a topic that we're discussing over here in London, but also in Paris and other jurisdictions in which we have our private banking. And just as a way of introduction, I'm part of the external investment solution team, which one of the prospects of that team is fund selection, and we are the gatekeeper of fund selection for the private banking, Société Générale, the retail banking in France, as well as investment banking through an open architecture of products with active managers, third-party active managers. Carbon and sustainable investing has been a big topic for us, not only because we have a lot of questions from our clients, but also we have done a lot of development. With a colleague of mine in Paris, we are overlooking ESG and how ESG can be implemented transversally into our profund list, and within that, which are the best products within each asset class. And with that comes also thematic, and with thematic, we have anything that is related to climate solutions and carbon investing.
Great, thank you. Sarita, I'll turn it over to you next.
Thanks, Tim. So yes, Sarita, I head up ESG and responsible investing at bfinance, and we're a investment consultant working with institutional investors across 45 countries, and working with them to help them and support them through allocating capital. My role at bfinance is very involved from a research perspective in ensuring that we're incorporating ESG, climate impact, within our research function, as well as working with investors globally from an advisory perspective, so helping them develop their policies and implement them through various ways. In terms of climate, I think we're all probably, hopefully, on the same page that this is really, really important, and it poses very serious risks, and we need to transition virtually everything around us to be able to meet our 1.5 degree target. So our role really is to help investors navigate through the risks, but also take advantage of the opportunities. So hopefully I can bring that perspective to this panel today.
Super. And Rob, last but not least.
Okay, thank you so much. I agree with Sarita that a massive transformation is required if we're going to hit any of the net zero aspirations that are out there. I'm going to give you a quick rundown on a few slides that I think will illustrate where we are in our journey to solve the question of emissions. So on the left-hand chart, you'll see very quickly here that global clean energy spending has been rising really fast. Last year, we crossed $1 trillion for the first time. This is spending on wind, solar, electric vehicles, these kinds of things, which is roughly the same amount that gets spent on fossil fuel development every year. On the right-hand side, you'll see global CO2 emissions. So despite the fact that clean energy spending has been rising very fast, global CO2 has continued to rise. We hit an all-time high this past year. So what the heck's going on there? Basically, it's that we are trying to replace a century's worth of infrastructure based around fossil fuels that have the associated emissions, and this is going to take some time. The blue bar there at the bottom is the renewable or clean energy piece of the global energy picture. So it's growing very fast, but from a pretty small baseline. Now, a couple charts that I think are pretty cool that maybe give you a sense of where we are in the race. Global EV sales, electric vehicle sales here on the chart, very interesting, rising very fast, something like 13% of total vehicle sales last year were electric. If you'd gone back just a handful of years, that number wouldn't have been predicted by most people. At the same time, global oil demand continues up and to the right. So we're not really seeing it nibble at oil yet. Very similar story on the renewable side of the equation. This is global installations of wind and solar capacity, one of my favorite hockey stick looking charts. The world is changing incredibly fast. We installed about 250 gigawatts of solar last year. This is an unfathomable number. It's very big. It's many times the capacity of that's installed today in the United Kingdom, for example. So very quickly changing landscape, but natural gas demand continues to grow up and to the right. Now, some would say natural gas is a carbon reduction strategy because it is lower emissions compared with coal. Global coal demand also up and to the right. You might be able to look at this chart and argue that it's plateaued, but we have a lot of work still to do if we are going to hit net zero, whether to hit 1.5 degrees or 2 degrees. Now, a couple of things that I would point out, so to say, well, how do you invest in this? Well, of course, there's wind, solar, batteries, hydrogen, carbon capture and storage, nuclear, electric vehicles, on down the line. Maybe a couple of names to just mention that have exposure to this theme. SMA Solar, just out with earnings today. They make inverters for the solar industry. We think that they're potentially going to grow their top line this year 35% or more. Very fast growing industry, fast growing company within the industry. Some of their peers would be Enphase and Solar Edge. Company like First Solar also growing very fast. On the wind side of the equation, Vestas, take a look at them. We have what's called a focus idea on Vestas. We think consensus is underappreciating how quickly they may be able to grow both their top line and EBITDA. Happy to chat about any of this and look forward to sharing just general thoughts on the pace of the transition and who's exposed.
That's great. And look, I think that sets the stage up on any number of different levels for us. So let's dig into this a little bit across the three of you all. To begin with, let's talk more conceptually about investing in carbon reduction. And this could be at the company level, or it could be at the fund level, knowing Sarita and Kalinka, you think more along that sort of level in various ways. And there's a spectrum of choices that investors can consider. There's pure plays in green technology, and that could be a wind turbine company, or there's companies or funds that focus on the companies that are enablers that are needed by the pure plays. So steel companies, mining companies, it's kind of weird to think of a steel or a mining company as a copper company as a carbon reduction idea, but in ways they can be. Or thirdly, leaders across other industries that are driving change within energy transition or making progress themselves. Think about integrated oil companies that are shifting their capex towards renewables. And not to belabor this setup on this concept, but I did find it interesting at last week's Stockholm Fund Forum event that I had mentioned earlier. There were three presentations that were geared sort of towards these different avenues. There's one from Pictet, there's one from TT International, and one from Polar Capital. All three are oriented towards the energy transition with very different strategies. And so with that, the thing I would put forward to you all from a panelist perspective is, how do you think about these different strategies that in some cases seem almost conflicting? What do you find most interesting, either from your own work or in your discussions with clients right now? Is it the pure play? Is it the enablers? Is it the leaders that are trying to drive change across whatever business they're in? And yeah, we can go however. Sarita or Kalinka, if one of you all want to jump in on this.
Sure, maybe I'll give it a start. So I think absolutely an important kind of topic, because there is this mindset of potentially, when you're thinking about decarbonization and carbon reduction, you're potentially looking towards the carbon solutions or climate solutions companies that are enabling that transition. But I think the way that we formulate this thinking is around, as an investor, what is your measure of success and what are you trying to achieve by investing in all of these? Of course, there's the investment opportunity, but at the same time, we're also investing in this landscape because we want to make a real world change. So we know that the kind of high emitter sectors need to transition. We know they have a role to play in our energy transition. So it's really important that you're not necessarily just excluding that part of the universe to focus only on the solution side, because there needs to be a combination. And in fact, it is your high emitters that will be investing eventually in the technologies from the solutions to help them transition. So I think in taking a holistic view and trying to think about your carbon footprint, whether that's, if you're trying to achieve a green portfolio in a dirty world, for example, I mean, are you having a real world impact in what's going on in the actual energy economy? So I think it's important that all of these three play a role in our conversations as well. Of course, there's regulatory risks, there's reputational risks. So investors need to be mindful of how they invest. But I think it's important to keep in mind that we need the transition and we need that transformational impact to achieve what we're here to achieve.
No, fair enough. Kalinka, what comes to your mind?
It's a very interesting topic because we do hear different things from different clients, and basically, if we exclude 2022, there was a lot of requests about climate solutions and transitions, and obviously the different COPs they have helped on that. But if we look in 2022 and what happened there, the war in Ukraine and everything else, there was difficult performance for all type of asset classes, and that brought difficulties for clients to require for environmental or social type of strategies, which means that there is an educational effect there where it's not only on a 1 year basis. This is a trend that will continue through the years, and that we are there as well to advise them that although it may be a difficult year of performance and for those strategies, they're still there to create that real world that Sarita was talking about. And what we've seen is that in terms of climate solution, or in terms of proposal of funds, there were three types of funds, and that where it comes as well the educational part from us. So you have what would you call the exclusion and the investment fund. So these are the funds that will exclude all the high carbon emitters, and the issue with that is intuitively clients will go to them first because they'll think that ultimately this will be your green portfolio. But it's very difficult to generate good performance because in terms of universe, you'll have a very low diversification effect, but also high tracking error or Sharpe ratio will not be as a client would like to. The other part that we've seen is the net zero transition thematics. And this is the main part of where we're seeing asset managers putting place in. And these are the type of solutions where you'll find those enablers, those improvers, but also companies that are in the transition side, companies that may not look on ESG metrics good enough today, but that they have the conviction and they're engaging with them. So in 5 or 6 years or 10 years or more, they will be looking better. They're helping them in their pathway in terms of low carbon emission. And at the end, what we've seen is products mainly in the ETF side that are carbon removals or carbon offsetters, but there are very few out there. So definitely, we are here to educate our clients the type of products that they would like and to give them the solutions for their specific portfolio in a way that they have to be able to accept the transition mode and that it will take time and we need to invest from now for the better future in 2050 or 2100.
No, fair enough. Rob, thoughts to add to this?
Well, I think that there are a variety of approaches, and I think one of the most interesting questions that comes to my mind is just simply whether the strategy you want to execute is just avoiding an entire industry or an exclusionary approach, or do you want to contemplate the idea that some of the companies that have been responsible for all of the emissions in the past may very well participate in the transition? Two examples, BP, through its partnership with Lightsource BP, have a very large solar portfolio. So, as an investor that wants to optimize their portfolio around emissions, comfortable with a company like BP, knowing that. Similar with Equinor. Equinor is the Norwegian oil and gas company, and they happen to have a very large offshore wind development pipeline. So I think the world is changing, and so the broad kind of question that I would perhaps be considering or thinking through is just how do you achieve access to this kind of objective, because nobody knows for sure what the future looks like, and there's many ways you could sort of approach this question, and I'm sure we would have some good debate about whether oil companies belong in the portfolio or not.
Yeah, Lord knows. I mean, and again, at some of these events, it's been an interesting topical debate in some of the panels, because you end up with somebody running a fund that is exclusionary versus somebody running a fund who is transitionary versus somebody who runs a fund that is pure play. And they've all got good arguments, and they can all show the possibility for potential returns. And again, I think, Sarita, as you said, sometimes it just depends on how these are fitting from a portfolio perspective into somebody's overall investment objectives. All of which is, yeah, please.
I was just going to jump in with that point, actually. One of the things, that you want to be very comfortable about if you are in the transition kind of space is that you're looking for the fund managers and or companies, to Rob's point, that are demonstrating not just these ambitions, not just demonstrating the targets, like being an SBTI target or just ambitions around the transition, but actually looking for the CapEx that is going into this. Because what we're seeing more and more of is, elevated oil prices, reducing CapEx into green energy, that kind of dimension of how urgent is this for this company and how committed are they? And then from a manager perspective, I think stewardship and active ownership are so important. So a manager being able to demonstrate that clout and engagement and voting with some of these companies will actually help with the transition, as opposed to a manager that kind of uses this excuse to get exposure to a sector that's important, but then doesn't actually transition those companies underlying. So a bit of an important point to think about when choosing the specifics.
Now, well, let's carry on with that a little bit. It's funny because there was a phrase that I think both Kalinka and Sarita, you both had used, and that was climate solutions. And it seems in a way it's one of those buzzwords, for lack of a better phrase, that you hear a lot, and yet it probably means different things for different people, both at the fund level as well as companies that are focused on driving some kind of a positive climate change. I did a little bit of Googling, which, it's a normal sort of thing. And I came across a Harvard endowment phrase, statement that is in their documentation about, what is climate solution? It's those seeking to accelerate change required to reduce climate carbon emissions in the real economy while positively impacting our portfolio-wide net zero goals. And in doing further searching, and I bet if I hit refresh on this, or any of you all did this, you'd probably come up with different examples. But just on my Google search, so this is no endorsement, it's just how my browser showed up. But AXA Investment Management, Schroeder, Lombard Odier, Bailey Gifford, State Street, Robeco, except that JP Morgan, these all showed up with climate solution products in one form or another. And in digging into these, get to my question, it seems like there's various components that fold into this idea of climate solution, whether it's sustainable food or sustainable construction, new developments in transportation, renewables and electrification, circular economy and recycling. All of those are pieces. So question to you in your conversations with clients or the work you're doing, what's most interesting or intriguing in terms of what you're hearing from investors or what you see in your own work right now as opportunity? I'll throw it out, whoever wants to go first on this one.
Maybe I will start here first. There is a storytelling here, and there is a lot of marketing around all these kind of climate solutions. And it's very easy to go to a client and to speak about an asset manager going to a client and speaking about those products, because he or she can easily relate to. So therefore, they would like to buy it immediately, and they're asking about all of those products. But we need to be very conscious of who are the pure players, how they're constructing their portfolio, what type of metrics they're using, how can they produce you the impact outside after investing in all of this product and solution. And also, are they investing in solution only, or they're investing in products as well? So from our point of view, the way that we are looking at on thematics specifically, although we are active manager analysts, we also have a list of ETF products that we are advising on. And from our point of view, we're on thematics and sustainable type of framework. What we're doing is that we don't shy away of saying if some strategies they're better invested through an ETF, for example, because you can first find more pure players. You can create some sort of a portfolio that can be tracked, and some of the ETF players I'm not going to name specific names, but there are some good ETF players out there with good range of products. But also because the universe is that small, for an active manager to be able to create a portfolio, it's very difficult for them, and they have to go outside of the pure place and invest mainly in the supply chain. So example can be battery storage and lithium. We don't shy away, and we say in this type of technologies, it's better to invest through an ETF. But where you have more of a clean energy trend or infrastructure that can be linked to the climate solutions, that can be invested through a fund where you have a good enough exposure of stocks that an active manager can use the pool from.
Yeah. Any other thoughts on this broad topic of climate solution? Yeah, Rob, go ahead.
Yeah, okay. Well, I'm happy to offer a couple of thoughts just on the idea, because I think investors are chasing return, right? You're not just pursuing the goal of reducing emissions. And a couple of things come to mind. I'm going to share my screen again because there's two charts that I think can help us look at this. So up in the right-hand corner, if you do have a terminal, by the way, I'm hovering my mouse right there. You can you could load this chart. But this is the S&P 500 3-year price run versus the S&P 500 fossil fuel free. So just the exclusion approach idea is saying, look, let's get all the sort of companies that have fossil fuel as a core of their business in the S&P 500. Just let's look and see how they've done. Pretty neck and neck. I would note that over at least, it always depends on where you start something like this, but the fossil fuel portion of the S&P 500, the fossil fuel free is the blue line. So it's not really done really all that different than the actual broader index. Now, if you had a different strategy and just said, look, solar is the way to do this, here is the MAC Global Solar Index in blue, also again versus the S&P 500. So I think there's a lot of ways you can ultimately try to tackle the question of, you know, what kind of investments are going to get us to that fossil fuel free future or the carbon reduced future. And you know, depending on when you execute your strategy, whether you go with a sort of basket of stocks like the ones I just showed, or whether you do the individual shot selection, I think, you know, this is just one more piece of the onion that you're trying to peel with an investment thesis, and you still probably want to be looking for companies that are growing profitably.
No, fair enough. Makes sense. I'm curious to tilt this a little bit. We've been talking constructively and positively about investing in carbon reduction, but I think it would be remiss if I didn't ask about the flip side. Is there any sense from any of you all about sort of climate change or carbon reduction fatigue here in Europe in conversations you're having? The reason why I ask is I'm sure you're probably well aware, or if not, you've seen headlines or what have you, but there's an increasing amount of press in the States about pushback on investment guidelines and integration of ESG into, say, pension plans for public endowments and things along those lines. I personally don't get the sense of this over here in Europe. Definitely see on the other side of the Atlantic. Curious what you all think. Any perspective on this?
Maybe one for me. So I think from the investors, I mean, as I mentioned, we are global, so we actually hear from very different parts of the world. Definitely in Europe, I think that there's just such a push, a regulatory push, but also a social kind of, or a broader awareness around this topic. And I think investors actually have been quite forward in terms of trying to allocate capital in this space. For us, we actually did a survey of at least 400 institutional investors globally, and infrastructure just specifically, taking that as an asset class. More than 40% of investors expected their exposures to rise. So it's a growing trend. And maybe just a bit of a different view from a US perspective, actually. I think that if we look behind or beyond the headlines, there's still a lot of really good action that's taking place on the ground in the US. And I think the Inflation Reduction Act, that kind of pushing a lot of this kind of technology or investment at this point in time. And in fact, I was reading something that said that renewable energy has taken over nuclear and coal for the first time this year. So there's a big change, but I absolutely agree with you that the ESG agenda, if you separate that, it's actually very touchy and depends which state the person or the investor is operating in.
Anybody else want to jump in on this one?
Yeah, I'll take just a stab at this as well. Another kind of chart comes to mind, just generally kind of hearing Sarita talk about IRA, and just there's a policy angle that I think matters. And for anyone who's not familiar, here in Europe, we actually trade carbon allowances. So one option for gaining exposure to the idea of carbon reduction is the carbon market itself. I'm going to share my screen one more time. I probably won't share it again, but if you're unfamiliar, the blue line is the European carbon market, just up and to the right, white line's oil, just to give you some context of what's going on. We have seen a structural change in carbon allowance prices over the last 3 years plus or so, plus or minus a couple, in Europe, where the price is really taken off. And why is that? Well, one is the European governments have said, companies, we want you to reduce emissions faster than we had told you previously. And so there's this price signal that's out there that's basically indicating to a whole variety of companies, steel makers, electric utilities, refiners, cement manufacturers, on down the line, that they have to pay for their carbon now. And this is essentially an asset class. There are ETFs and others out there that have exposure to this. So it is not just about, I suppose, equities or even the credit side of the equation. There are interesting financial instruments like this that are out there that have that kind of policy tie-in. It's not the IRA, but these kinds of things are shaping some of the outcomes that we're seeing.
So that is a broad overview. I'm curious to dip into a little bit of the specifics that one might look at on carbon reduction. And some of this may be geared towards certain specific funds or classes of funds. Some of it may be certain specific companies, but exploring ideas on certain I guess obvious strategies that we ought to think briefly about. The first one is sort of conventional carbon abatement options. Think of it as renewables, wind, solar, electric vehicles, natural gas. So some of these are renewable, some are beyond renewable. But any sense on within that? It's kind of weird calling this traditional sense, but the more developed sense of what your clients are most interested in at this point. Kalinka, Sarita, Rob.
I will add maybe to that property as well, because when you think about property, we spend a lifetime in property, whether or not our buildings where we work or where we live. So carbon emission in property, it's a crucial thing as well. And to have more greener property is something that is starting to develop. And we see a lot more buildings being renovated and improved, and green in real estate is becoming a thing. In that respect, here in London specifically, we are very excited about wind, solar, and property as well as infrastructure through an investment trust lens. And we launched a fund of investment trust into all of those topics. Basically, it's investing in all of those 4 areas: wind, solar, infrastructure, and property, to be able to deliver, invest in companies that they are actually helping for a better world in the future. And we had a lot of excitement from multiple clients, and even the continent now is very interested to dive into that kind of asset class that is very different from a long-only mutual fund. And because that's where we see the impact. These are the strategies that we like, because we can see and measure the impact behind.
No, fair enough. Sarita, Rob, thoughts on this one?
Just for me, I think there's a broad interest in infrastructure in itself, as I was saying before, and within that you get diversified portfolios. So you'll have core plus this renewable exposure within that. We're now seeing a lot of funds come into play which are renewable and then clean energy, and you're getting things such as bioenergy, thinking about methane and how you can extract that and put that into a form of fuel. And so a lot of like innovation within the space, I guess, that's happening, that's bringing together, taking that kind of infrastructure exposure and then developing that into more of the clean energy type solutions, just focused on that. The only thing I would say though is that a lot of this stuff is quite there's a lot of investment needed, and there's a lot of there's a little bit of risk, because some of these technologies are still evolving. So it depends on the risk return profile, but we're definitely seeing a lot of fund managers bringing some really neat stuff that's accessible now to institutional investors.
And Rob, I know that you mentioned focus ideas before, and you shifted gears from having a focus last year on First Solar, and this year it's Vestas, and it's been interesting seeing how different opportunities seem to be evolving within the context of what the market's discounting or not. What are you thinking at this point?
Yeah, so a couple of things, and I might actually have a follow-up question for Sarita and Kalinka, because just hearing them speak. But yeah, so we are very positively inclined about the fundamentals at Vestas at the moment. The wind industry is poised to grow very fast over the course of this decade, particularly the offshore segment. And when you're thinking about investment opportunities, you are often sort of questioning, well, is this already built into expectations or is it not? And in the case of Vestas, we look and we sort of say, look, consensus seems to be pretty pessimistic about how fast they're going to grow turbine deliveries and how fast EBITDA might grow. And in addition to just simply a fast energy transition that we think is on the deck because of not just the IRA that Sarita mentioned a little bit ago, but because of Repower EU and some of the evolution of policy here in Europe. But lower steel prices are a godsend for the industry, and they have been sort of rising a little bit here in the near term, but they are a lot lower than they peaked at after Russia's invasion of Ukraine. And so, I think Vestas potentially has a potential beat to consensus in the coming years. Now, that doesn't mean that have much read across for solar. There's a number of names that we see very fast growth for. And one of the interesting things about the solar business is that from a valuation perspective, it trades at a pretty high EV to EBITDA multiple, about 15x across our global solar theme basket. The broad world market, by the way, is about 10x. So you're paying kind of a 50% premium for your typical solar company. And the question should be, why would an investor want to do that? Well, it's because the industry is just growing so darn fast. Last year, global solar demand increased about 40%. So a lot of the solar companies' top line growth, many of them grew 40% or even faster. And this year, we think global demand could grow 25 to 40% again. So we've got a really robust top line growth scenario that's been unfolding for the industry. And by the way, a lot of people tend to think that growth businesses aren't profitable. You think of Amazon from back in the day or whatever, but a number of these solar names are actually generating profit as they grow. So anyway, I think there's a number of specific cases to perhaps take a look at. The question I was going to sort of flip around because of hearing Kalinka and Sarita talk about both infrastructure and kind of wind, solar property, these kinds of things. Very interesting to contemplate that being in the portfolio. But one of the things I've personally observed is that a number of the strategies out there for this kind of topic often tend to get overweight on the tech industry or the banking industry. And I'm not saying that you've necessarily advocated any of your clients to do that, but I'm curious, how do you think about concentration risk? Because when you look at the companies that have said, hey, we're going to do net zero, we're going to commit to 100% renewable energy, all these kinds of things, they're often sort of non-capital intensive kind of tech type players. So I'd be curious, how do you kind of think about that and fitting and squaring it with the overall investment universe?
I love that question. Scope 3, that's the answer. So they seem to, I think the certain parts of the universe and sectors get overweight because they're not capital intensive and they're not resource intensive from the traditional way. And I think that's the reason why I think this idea of being intentional about the type of investments in the funds that you choose and the investment managers that actually look beyond the data to find these companies that are actually part of the transition, I think is really, really important. I don't know if Kalinka, you have anything else to add?
Yeah, I love that question as well. And I think that I fully agree with you. And this is one of the reasons why we have chosen to go through the investment trust pathway, because investment trust, the type of investment trust we invest in. So, for example, Bluefield or Jalen or Trig or any of those that they have plants and they have actually the solar panels somewhere in Europe and also globally, because what we've seen in terms of players, you do have some ETF players on the wind and solar, etc. But on the active side, you have overcrowded effect of some stocks, and everything else is supply chain or something that is touching eventually to the team, and it's not enough pure play for us.
Fair enough. I do think it's interesting talking about some of these areas that have been around for a bit. They clearly go through some hype cycles, and it's interesting if you can ride them on the way up. You have to be careful when they get overhyped because of whatever reason, too early, or valuations got extended because of concentration, and the hype deflates, and then it goes into maybe the real world where it's a real business. And what comes to mind with some of these more traditional areas right now, part from a cyclical perspective with all that's transpired recently, part the hype cycle, is electric vehicles. It's not been part of this discussion really at all, but clearly transportation and what's going on with vehicles, cars, as an example, are a big deal. Our inclination in BI has been more the traditional auto manufacturers that are pushing forward and changing their portfolios, as opposed to, say, the pure play of a Tesla. The one, go back to the idea of focus ideas, the one focus idea we have right now that's active across this space happens to be CATL, the battery company, that is the leading battery manufacturer. And it's something we stepped into back a few months ago. Stock it hasn't quite halved, but it's close from its peak. And the growth is dynamic. Lithium prices have retreated to a degree, and it's one of these that just seems to have faded a little bit from the standpoint of the visibility, but fundamentally looks quite interesting. So it's intriguing to see. It's not just necessarily a invest and hold. There are cycles and dynamics to take advantage of. I know that we're running long in time, so I want to be a little careful. There were two other things that I wanted to ask about. One is there are some other specific areas within carbon reduction as a concept that we really haven't talked much about. One could be nuclear, or something like carbon capture and storage, or hydrogen. Some of these there's public companies, some of these there's funds that might tilt in those ways. In some of these cases there's some early stage, private companies that might be more in the alternative investment space. Anything along these lines that come to any of you all's mind that are intriguing to you or your clients?
I mean, I'm happy to sort of jump in on that and just offer that nuclear is a very challenging industry to generally invest in. I mean, you could perhaps take exposure to a utility that has a big nuclear portfolio within its generation asset base. There's uranium, the commodity. There's a bunch of private money that's been flowing into companies that are trying to disrupt the nuclear space by creating small modular reactors. So basically, you build a nuclear plant on an assembly line instead of building them on a one-off basis. Let's see whether that plays out. But I think the difficulty with nuclear has been just the sheer amount of capital required. We're talking in excess of $10 billion on a typical plant, and many of them tend to run over their initial cost estimates and take a lot longer than initially anticipated. So I think nuclear has been very challenging. Let's see if SMR concept changes that going forward. And carbon capture and storage, look, it's an interesting concept, because when most of the people when the IEA or any sort of big group that looks and says, hey, how do we get to net zero, they can't quite figure out the path without throwing in a little bit of carbon capture and storage, or things that just aren't available today, right? And so I think there are another number of companies that are really interested in CCS and want to do it. Most of them are traditional energy players that have emissions in their portfolio, and they say, hey, we could capture some of that CO2, and rather than let it go in the atmosphere, store it somewhere. So let's see whether we actually see that play out or not, but both a bit challenging to invest in from a pure play perspective.
Yeah. Sarita, Kalinka, anything?
I pretty much agree with that. And I think the carbon capture part is probably part of a diversified portfolio, if it makes it in there, but fully agree. And I think nuclear has been contentious, and the EU taxonomy has brought it back in as a transition. So that's interesting. I mean, it has been met with a few challenges, but I agree with everything Rob said.
Same for us. We actually had a couple of clients actually from different entities looking for nuclear and investing in nuclear. And to what you said, Rob, the only way where we basically look at it is, okay, from a ETF point of view, where you can invest uranium ETFs. From a fund point of view, where it could say to utility, so eventually a fund with utility. But even we had further look of availability of the data, and we looked at Article 8 and Article 9 funds overall within our list, but also overall within the industry. And actually, when you look at in those, the portion of nuclear is very small. And Article 9 funds, when we're speaking to Article 9 managers, they're saying, well, look, it is interesting, but it's very criticized. There is, as you said, Sarita, your taxonomy, but as of today, we are not investing. So when you look at the real portion, Article 8 and Article 9 in European asset management world is 42% of all funds. And within those 42%, if we just take the Article 8 funds, which is the bigger portion of it, you're going to find just 1 or 2% investing in nuclear. So it is not something that is easy to get investments around. And on the carbon storage, there was a study made by the, forgive me if I get it wrong, Institute of Economics and Energy and Economics and Financial Analysis. And basically what they were saying is that today carbon storage is very difficult to invest purely because there is insufficient data to prove the ability and the effectiveness of the technology.
No, fair enough. Well, let me ask one last question. And what I'm going to do is ask the question I was gonna ask, but I'm gonna blend it with a question that came in from the listeners, and so it's gonna be a look in two different directions for each of you. My question was gonna be, knowing that not everything is rosy, it's not all a cakewalk. What's the biggest challenge you see, most pressing issue that you see from an investing perspective in carbon reduction? You could take that in any number of ways that you might want, but what's the biggest issue? And then the question that came from listeners is there an opportunity or a sector that you think really deserves more visibility within carbon reduction? So if I rephrase all of this, what are you most concerned about? And what's the single most intriguing opportunity to you that somebody ought to take away from this call to go and explore? So who wants to go first?
Maybe I'll take that. So I think there's a lot of risks. Just because you're in the clean energy or clean space doesn't mean you get a free pass. I think physical and climate transition risk, climate risk, and the impact on assets, that's important to think about. And from a sector perspective, I think agriculture is an area that is potentially getting less attention, but needs a lot of attention because of the level of emissions from that.
For me, one of the challenges is have a clear mind of where is the greenwashing, where is the marketing, and who is on the bandwagon of that trend that everyone wants to be on. There is asset managers on overnight, they have revamped all of their strategy and they become climate, thematic, ESG, and everything that you wish for. So it's just try to be clear of where you goes and how you define, because it's very subjective, how you defined climate solutions to see which are the players that you may like and may fit the portfolio of your clients. In terms of sectors, I agree that some of the natural resources sectors are very unloved or have been unloved or unlooked. Also, investors should be aware of the crowding in technology because, as we alluded to through the call, there is a lot of linkage to technology and they can be crowded effect in certain stocks. Technology can be done in climate solutions in different ways through the digital democratization, tech health, and different type of sub-industries. But just be mindful that this is not a way to create a portfolio and where exactly are the pure players.
Rob?
Yeah, okay. Well, for me, what I would say is that solar demand seems to be on this incredible rocket ship. So over the next 3 to 5 years, look for incredibly fast growth from the solar industry. When you look out in the 5 to 10 year range, wind could potentially kind of have that same narrative. It takes a little bit longer to scale up a wind project and the associated manufacturing capacity. But when you think about wind and solar, we know they're intermittent. but we know that they can't be the entire piece of the story. So you have to ask yourself, what fills in for the gaps when those resources aren't available? And there's all kinds of questions. It could be nuclear, it could be CCS, it could be hydrogen. But in the very short run, I would be looking at the pairing of batteries paired with solar. And if you haven't looked at the economics of that in a while, you may want to take a fresh look, because I think in the past you would have said, solar's too expensive. Well, the costs have come down. And now you'd say, well, solar's cheap, but solar plus battery too expensive. Solar plus battery in many markets is cost effective today. And one of the main reasons why is because natural gas prices and all these other things and power prices have gone bananas. And so the power price has gone up, and you've got this learning curve where solar plus battery have been getting cheaper. So take a look at that. We are very optimistic about the potential for battery storage on the grid to make some incredible leaps and bounds in the coming years.
Well, look, really appreciate everybody's insight. I think we covered a lot of ground, from top-down conceptual to bottom-up ideas and thoughts. The intriguing parts, the difficult parts, some of the challenges ahead. I see a lot of this on an ongoing discussion basis with my son, who's a climate change officer in a large council in the Midlands, and it's intriguing from his perspective. You know, real world refits on the infrastructure of their key cities, or the possibility of considering hydrogen in a facility off the M1 that could be, a pretty cool facility. And so this stuff is real world. It's investment world. We're going to be in the midst of it, for a long time to come, and really appreciate you all's insights. And we'll look to bring this version of Trend Watch to a close, and hope many of you all can dial into the next one in late April with a different focus. So Kalinka, Sarita, Rob, thanks very much for the thoughts, and we'll bring things to a close there.
Thank you very much. It's been a pleasure.
Thank you.